Let's start with our weekly wrap segment. We're going to start focusing on a poll question. We asked all of you, how important is sentiment? Things like the AAII survey, the name exposure index. We usually talk about those on our Thursday show because that's when a lot of the weekly data is updated. How important is sentiment in your process? The most common response, somewhat important, 36%, followed by not very important, 27%. 19% of you say you never look at these things, and 19% of you said very important. That's about what I would expect. I'd expect people to be sort of medium, lukewarm about these. To be honest with you, I have always found, I'm thinking of conversations I've had recently with like Mark Young from Wall Street Sentiment, Jason Geffert from Sentiment Trader, and they have made a successful career out of focusing on market investor emotion as reflected in the weekly sentiment readings. They do a fantastic job of it, and I've always remembered how important it is to have that check-in. For me, as I've always told you, it is not the number one thing I pay attention to, but it is a crucial part of that toolkit. It starts with price, and then breadth, and then sentiment. Price is king. Price is most important. Breadth qualifies that movement in price by telling you about participation, but sentiment is a really important way to see how people are actually understanding the market environment. And when the market moves and sentiment disagrees, or when sentiment is at extremes, which is when arguably those indicators are most effective, that's when there can be a real message there. And we're coming out of this scenario here, excuse me, in the first month or two of 2021, when sentiment has certainly been at extreme levels. And so I think it's worth paying attention to some of those indicators if you've not done so in quite a while. We'll do a quick recap of some of the key charts. We'll look at the weekly trends and how they evolved, and then we'll go to our Mindful Investor Live ChartList to focus our time and think about how things have unfolded week to week. The S&P really choppied around for much of the day, finished down about 0.5%. Mid caps and small caps actually finished in the red as well, even though they were positive for much of the day. The Nasdaq, probably the big outlier, up about 0.6% for the Nasdaq 100, and the VIX back down just above 27. Bonds back moving up. Apparently, I'm now learning that bond prices can go higher, and we saw that today with the TLT up 3 1/3%. 10-year yields back down below 1.5%. But again, certainly, at elevated levels relative to what they've been historically. Commodities really took it on the chin today with gold and silver, precious metals, also base metals like copper moving down materially through the course of the day. Energy was the weakest of the 11 S&P sectors. As well. Cryptocurrencies essentially flat to down. These are relatively low percent changes on an asset class that has been known for volatility, and rightly so. Not so bad today. I did want to focus here on the wrap the week. I didn't get a chance to update these labels, so forgive me for that. I'll do my best to point out where things are at and talk you through some of the indicators. The S&P 500 is here in black. Finished the week down 2.5%. If we go to the, let's see, what underperformed the S&P, gold had actually been doing okay, but actually finished negative because it sold off a little more today, as well as yesterday's session, finishing down about 3%. In purple, we have small cap stocks down 3 1/3%. Far underperforming, we had the Nasdaq down 5% for the week. And here in orange, we have emerging markets down 6.6% for the week. What outperformed the S&P 500 this week? Well, with the rally in bonds today, bonds actually finished flat for the week, which will improve over the S&P's returns for the last 5 days. The dollar was actually up 0.7%. It's interesting that rotation from a weaker dollar environment to a stronger dollar environment would certainly be a different feel than what we've seen here for many, many moons. But again, still early days, and I think there's a lot to be proven before we can say the dollar is in any sort of constructive price pattern overall. Most recently, it was a breakdown of a key trendline support, but up 0.7% this week. The big winner was crude oil, which still, with today's pullback, still finished 4% higher on the week. Now, when we add Bitcoin in the mix, usually it's an outlier. It was down here, down 17% for the week. Really, cryptocurrency is obviously pretty wild, but you've seen a sort of a risk-off feel to the chart of Bitcoin, really chopping around, testing that first key Fibonacci support level. And I think if we do break that second Fibonacci retracement level, around 42,000, if I remember right, I think would be the one to look at. Let's look at the chart here and see if I don't consider myself great at picking out levels out of a hat. I wasn't far off. 40,000. I thought that didn't sound right. 42,000 was the peak there from January. 40,000 here. It always frustrated me when I worked with Tom DeMark more closely. He would tell you particular turning points, inflection points on the Nikkei from like 1984 or some random turning point. And I can't remember Bitcoin from last month, but that is why I look at the charts because the data is all there laid out for you. So there you go. Let's continue on. Just check in on the markets in the form of the Mindful Investor Live ChartList. If you've not seen one of the Friday shows before, this is all a chart list that you can access. If you go to your member dashboard and go to chart lists here on the, I'm sorry, actually, that's not right. Click on articles here at the top. Go to my blog, which is called The Mindful Investor. And at the very top of that, you'll see this button that says Live Chart List. That's the way you can actually access this exact list of charts that we're going to review together. You're welcome to save them in your login, tweak them, adjust them, do whatever you want. Chart number one is the S&P market trend model. We review this pretty regularly, and it's updated every Friday. It's based on weekly data. So during the week, I'll check it out, but it's really about locking in the Friday close and identifying the long-term trends. It has three components: short-term, medium-term, and long-term. The short-term component essentially looks at where the close is versus the 5-week exponential moving average. This is the first time we've closed below it since the pullback in January. Before that, you had to go all the way back to last October. We actually closed below it this week, and it was interesting to see, today, see if we'd have a bounce to take us back above that level. We did not. So as of now, I'll rotate this to a short-term bearish signal. That's a tactical bearish trend on the S&P. The medium-term trend measure, which is here, it's basically just using the weekly MACD, or what we call the weekly PPO, the percent price oscillator, using the traditional settings that most would use. And on the weekly data, it's simply when we get a buy and sell signal, a crossing of these two indicators. We got a sell signal today. So locking in on the close, we have the short-term crossing down through the long-term. That's the first sell signal. It's been bullish since early November of last year. It turned negative sort of mid-October on the pullback there, and then turned positive a couple weeks later. We've now registered a sell signal. So the medium-term trend also bearish. The long-term trend, nowhere near bearish. This is really meant to capture more about the longer-term trend, sort of the long cyclical read, even the secular read. And in general, this has been bullish since early June, and for the most part, for the last 10 years has been bullish. So we'd have to sell off and have quite a distribution before you get a sell signal from there. So in terms of the tactical read, the things that I tend to look at as a way of determining what I would do with new capital, the short term and especially the medium term are the two I would look at. The fact that we've gone to a medium term bearish signal, in my opinion, suggests you need to start to be a little more cautious and think more about the risk potential than the reward potential. Be looking at your positioning and thinking about what lines in the sand and making sure those are updated, because we have a heightened risk now of further distribution and breaking key levels of support. So that's kind of where we're at with the market trend model. The daily S&P chart here, I'd mentioned on social media earlier this week, the 3-step process to validating a sell signal in terms of the S&P transitioning to a bearish phase, in my opinion, has 3 parts. Number one, you break your first trend line, which is this pink trend line here, which we broke back here in late January. We rebounded and then tested it from below, and now have rolled over again. Step 2 is you break the 50-day moving average. You actually broke a second trend line, which I didn't include as one of those steps, but we did break a second trend line. Take the October low and the January low. We actually closed below that yesterday and validated, followed through with it today. We closed almost to the tick right at the 50-day moving average yet. So I don't think I can declare that a break of the 50-day. At this point, it's found the 50-day, much like it did at the end of January. So the decision point for next week, or the question that the market will have to answer for us, is this a late January pullback to the 50-day before a resumption of the uptrend and a push to new highs, or do we finally break the 50-day for the first time since back here September of October, which tells us to expect at the very least more of a consolidation phase, a multi-week, multi-month consolidation phase, or even something deeper. And again, there's a non-zero probability that we have a materially lower move from here, that we test 2,900 or 2,850 or even 2,200. I'm not saying that's a high probability, but it is a probability. And when we break support levels up here, that's when these levels seem a lot more reachable, right? A lot more possible. And all it does is to make me rethink what are the probabilities of those things happening, and what would I do in some of those different scenarios? So step one, we have accomplished, which is a breakdown of the first trend line. Step two, a breakdown of the 50-day. I don't think we've seen that yet, and next week we'll have to see if we follow through or not. And then step three, which I didn't mention, get below the January low, which would be around 3,700. If we follow step two and step three, you will hear me get a lot less constructive, a lot less optimistic about recovery phase, and more thinking about how to circle the wagons and protect yourself, for an increased likelihood of a further downtrend. I've talked about, at the end of the year, my projection for 2021, which again is always something that's more instructional and less predictive in my experience. But overall, my guess was more of a 2010 type of move, which is a choppy year following the 2009 bottom and rally. And then we ended up finishing positive for the year, but there was a lot of movement along the way. And I think we're going to have a similar year to that. I would not be surprised if we retest 3,200 before we would regain new highs. That would be a totally reasonable 2021, in my opinion. We have a couple minutes left. Let's go through each one of these, just a quick check-in. Breadth measures are mixed, some of them giving bearish divergences, some of them not. And one that's not is the key one that I look at, which is the cumulative advanced decline lines. These all continue to make higher highs and higher lows until that trend changes. It tells you overall the trend in breadth is is positive. One of the key tells I've found for distribution is what you saw January and February of 2020, which is the market going higher and these cumulative advanced decline lines sloping downwards. We're actually not seeing now. All four of those are continuing to be in uptrends. So that's actually not flashing a warning signal yet. Yesterday, I was talking with Carl Swenlin, who completely fixed an issue I had. I was trying to figure out why the new highs reading was so heavy yesterday. It was almost 15% of the S&P made a new high yesterday. But my screen for stocks making a new 52-week high was only 10 names, and that's because I was looking at closing data. How many stocks made a new closing high yesterday? Not many. 10 stocks out of 500. How many made an intraday high? It was 69 out of 500. Still 14% of the S&P made a new intraday high yesterday. So again, as much as this week felt distributive, and it certainly was in some ways, plenty of stocks making new highs. What is not making new highs is the percent of stocks above their 50-day, which is certainly an area of concern. That, combined with the euphoric sentiment, which we've covered, I think, ad nauseum this week, is certainly suggesting breadth conditions a little more negative. Sentiment remains elevated, but not euphoric. And I think one example of that is the name exposure index has come down this week from 105+% last week to 85%. That's down about 20 points. What that tells you is institutional money managers, large money managers, taking their foot off the accelerator a little bit. Just to finish off with some ratios, the cap weighted offense versus defense in consumer flat for the last month. The equal weighted, taking Amazon and Home Depot out of such an overweight of the numerator, makes this ratio go new highs. It still pays to own consumer discretionary over consumer staples. Staples are just not a good relative chart, and that's what that's telling you. Semiconductors continue to do well. We're going to look a little bit about this. I know there's a question on it in the mailbag that we'll answer, but I think this semiconductor group might be a really important one to look at as we go into next week. When you think about stocks that could be struggling, a bellwether group that doing well tends to make me feel good about the market, pulling back in the last week or two. And I think seeing if this can recover and return to new price and relative highs would be a very good argument for the bull case. That is our review for this week. If we didn't get a chance to touch on a lot of the ratios, but my show on Wednesday was a special episode focusing on ratio analysis. Check that out if you missed it. You'll fill in some of the gaps from the list today.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.